Hey, everybody, welcome back to the Micromath podcast. Today, we have our first guest. We're really excited about this. It's a company we've been following for, I want to say, almost 2 years now. And as you're going to see, a lot has changed. The market cap has exploded higher. And frankly, the fundamentals are looking better than they have in the past. We're very lucky here to have the CEO, Tony Marino, veteran of the space in oil and gas, going to share a bit about the story, going to tell us, we're going to talk a bit about the industry. Tony, I just want to say thank you so much for carving out time for us. We appreciate it.
Very happy to be here with you. My pleasure.
I know you're a busy man, so let's just jump right into it. We're very familiar with Tenaz. We've written about it. If you're watching this and you haven't read already, make sure you check out our research. But Tony, could you just give our viewers a bit of an overview? What is Tenaz? What is it you guys are all about?
Okay, we're an oil and gas company, a producer. Our business model is really oriented around successfully acquiring at good value and then subsequently operating to improve the results on producing oil and gas fields, primarily in an international setting. We're TSX listed. We're based in Calgary. We do produce in Canada, and later on, perhaps I get to an explanation for why we have this Canadian project. But mainly, the company is about buying oil and gas fields in Europe. Latin America would be a secondary area of focus, potentially some other parts of the world like MENA and perhaps one day again in Canada. But really, the main emphasis is Europe first, Latin America second, and taking existing fields, acquiring them at a reasonable price, and then doing better in the operation afterwards to generate more free cash, high returns on the acquisition. The company has been around since we began to form in 2020, and we effected a recapitalization of an existing Canadian public company. It was on the TSX Venture Exchange, smaller company called Altura. A gentleman who ran Altura is somebody we had worked with previously. And Altura agreed to a change in strategy. We brought in some additional capital. We continued to develop the Canadian asset that Altura had, a really good horizontal oil development project, and then set about this international acquisition program. And internationally, the acquisitions we have made to date are in Netherlands. We started with a couple of non-op acquisitions, and we just recently announced a quite significant, really for us, transformational deal to acquire a significant set of producing offshore assets and to be the operator of those assets. So that is really the history of the company. We moved up from the Venture Exchange, where we started when we recapped Altura, a little bit less than a year after the recap, onto the TSX Big Board, and that's where we've been trading for the last couple of years. Still a small company, a little bit over a $200 million market cap, and quite rapid growth. Pro forma for this acquisition, we would be 14,000 BOED. That production and the cash flow associated with it's not counted in our numbers until we close. That would be, we think, the middle of next year. But today, with what is officially in the ownership prior to closing that transaction, we're about a 3,000 BOED company. And through that transformational deal, we would go to about 14,000 BOED on a pro forma basis. And ultimately, we want to have additional scale in the company, a target in a 5-year period of 50 to 100,000 BOED. It's not all about being bigger. Really what we're after is value for the existing shareholders. But we know that to be relevant in the market, to get to this mid-cap market scale that we think is necessary, we probably need to be a company 50,000 BOED plus. And as we add assets and kind of consolidate in the areas that we start in, we get better operating economies as well.
Well, there's so many things I want to unpack here. And when we first found you, you say you're a small company now, which is true. But we first found you, you're about I want to say 40, 45, 50 million market cap. So from that to 200 plus, we've been amazed to see the rise. And this latest acquisition, I really want to unpack that. It was a pretty maybe not a complicated deal structure. It's a unique and very favorable deal structure that I want to talk about. But first things first, you mentioned M&A. That's core to this strategy, international markets specifically. At a high level, how do you know what to look for? Like, what is a good asset for you? How do you assess if this is going to be an accretive acquisition for the company?
Okay, it's a great question. The team that we have here that we started with has worked together for a long time, and it's been many, many years that we've been in this M&A or A&D business in oil and gas. Quite a technical group, engineers and geoscientists primarily, with some strong finance professionals in the company too. And the thing that we have learned, I guess, after these many years of working both in North America and the US and Canada and overseas, is that in today's market, we do strongly believe that there's better value overseas. It's not as competitive as it is in North America to get these deals, to acquire these assets. And when we say it's not as competitive, we go against fewer other potential bidders. Really, we prefer very much a negotiated transaction rather than an auction of assets. And when that occurs, and just really because of the structure of the international oil and gas business today, it means that on the initial acquisition, the deals are going to come off at a lower multiple, whether you want to look at a multiple of cash flow or production or reserves, at a higher base rate of return than they can in North America. So that's international advantage one. Then secondly, comparing a North American strategy to an overseas one, you find that these international assets have typically not been reinvested to the level that the North American ones have been, especially because we're often acquiring assets that are in the middle age of their life or in the latter stages perhaps of life, and rejuvenating these fields, reinvesting in them, bringing down unit costs, etc., working wells over, drilling wells to extend the life. There is just a much greater opportunity for this kind of operating improvement, improving the production curve, typically leading to increases in production where there had been declines previously, and cutting the unit costs so that our margins are better. So this combination of a better rate of return at entry plus a bigger operating improvement once you close and begin running the assets, we believe gives you a much higher rate of return than you can get out of a domestic or a North American acquisition. So this is kind of the twofold advantage that we think combines to provide such high rates of return, potentially high rates of return in international acquisitions. So we look for value on entry, so we know we're making a good deal. And in our evaluation of the assets, every well evaluated, every potential project evaluated, every facility evaluated to the greatest level of detail that we possibly can before we make our offer and before we make the deal, that there is a significant stream of projects available beyond just producing out. We don't want to be just in a produce out situation, but we try to structure the deals such that there's quite a high rate of return even there. And then when we can do projects, workovers, working on the existing well stock, which is these workovers, much lower capex activity than drilling new wells and putting in new facilities or platforms, drilling some wells as we move later into the operating phase, should, we think, give quite high rates of return. These are the two things we're looking for: value on entry and a lot of projects to implement over time.
Well, and just a question on that too as well, Tony, is, in this recent acquisition, it came from Shell and ExxonMobil. So I was kind of curious if you could speak to the advantages of your size and being able to acquire these assets from these larger players that are perhaps divesting for various reasons.
Well, in NAM, a 50-50 JV between Shell and Exxon, we certainly have a very high-quality operator that is owned by two super high-quality shareholders. And there's a tremendous advantage in working with these companies right away. First of all, you can count on them. You have an honorable and a sophisticated counterparty to work with. But secondly, in an asset base like that, you know that the assets have been very, very well maintained when it comes from two super majors, especially the ones of the really the very top end caliber in the world, like you have with Shell and Exxon. And in this 50-50 JV, of course, the same set of operating approaches, philosophies, techniques are applied. So we can be very confident that we've got a very, very good asset integrity. The wells, the platforms, the pipelines, the various machines that are associated with producing these fields are in very, very good shape. We do check it out ourselves, of course, but I think everybody could see how we could have confidence in that, taking it from such high caliber companies. The next thing that you get when you acquire from a big company is you get a very good workforce. Companies like NAM, with their shareholders, Shell and Exxon. They do a great job of hiring initially. They put a tremendous amount of effort into training their operating and technical and financial staffs, for that matter, and mentoring them along the way, such that you get a very high quality workforce at the same time that you're getting high quality steel in these acquisitions with a major. So it's, I think, quite advantageous to work with those kind of parties when we're making deals. Now, not every company of every size in the world is going to focus on the same types of assets. And with these kind of midlife assets, you do often, I'd say typically, tend to get a lower level of reinvestment in projects, in production rate producing projects like drilling new wells and working over older wells, installing optimized facilities for those very big companies. It really isn't what they emphasize. It can't really move the needle for them. And so while they maintain them very, very well, and they have a great workforce that goes with it to run the assets, absolutely essential. And that's a big part of what we're getting in this deal with NAM Offshore. There typically has been a low reinvestment stream, and this is what often leads to the big stream of projects at high rates of return that I talked about a minute ago. This is what we get in dealing with a company like NAM, owned by companies like Shell and Exxon. We're very honored to do it. We're an honorable and worthy counterparty as well, even at our small size, and it's a good step for us. In our previous incarnations of this team prior to Tenaz, we worked with these big companies repeatedly, making transactions with them, successful transactions for both parties. And so we probably know how to deal with them. All of us came from bigger companies at the beginning of our careers, benefited from that same kind of training. We're very lucky to get it. Gives us an understanding of working with the big companies. It's probably one of the reasons we've been able to be successful. We just understood the type of enterprise that we're working with from the very beginning. Throughout our career, then moving into the mid-cap set of companies that we've been with previously, we made deals with these kind of companies before, and now we're doing it again with Tenaz and taking it through this transformational level that puts us on a decent path, I think, to that required mid-cap size.
Well, you mentioned that the bidding or the competition, I guess, for these international assets is more limited than it would be here in North America. Given how attractive these assets are, how attractive the valuation is, why do you think they don't draw more competing bids? Like, why is it less of a bidding process?
Yeah, I mean, North America has the resource plays, right? In U.S. and Canada, it has sort of completely conventional production. It's got stuff in the middle like semi-conventional production that, for example, we work on our own Canadian asset. And then it has the very large unconventional plays. And these are not unconventional assets that we have bought with NAM Offshore in the Dutch North Sea. These are conventional assets. The North American industry, I think, has attracted so much capital over the years because companies know that they can apply very, very large amounts of capital to the assets, not always at super high rates of return, but at probably reasonably attractive ones, and with a high level of confidence that they're going to build scale out of a single asset. And that has just attracted a lot of competition to the North American assets. In our previous companies, we've dealt in that market. We've had success in it, even improving the operating results in North America after acquiring. And that's a challenge because you do have a super efficient industry, I think, in North America compared to the rest of the world. And this opportunity, all this service infrastructure that exists, the service companies and the large scale of the industry has certainly attracted a lot of competitors. In the international market, in the overseas market, there just aren't always, maybe even typically, there aren't a large number of competitors that are adequately financed, that have the operating backgrounds, that would have perhaps the financial sophistication, that would have the safety and ESG credentials, the HSE, Health, Safety, and Environment, and ESG credentials that are required to successfully own and operate in some of these more sensitive areas. As a result, the number of potential buyers for both of these reasons, the kind of the scale of the industries and the set of credentials really that are required, the set of buyers is really winnowed down. And you as a buyer, of course, you want a fewer number of potential competitors to go against.
Well, I was curious just on the side of the Dutch North Sea and your acquisitions there, like what stood out in that market versus other European markets?
Well, I mean, first of all, it's an EU market that we have known pretty well. It's a jurisdiction that we have known pretty well. Previously, we worked both offshore and onshore in Netherlands. I very much admire the country to begin with. It's a super successful country. It's super wealthy. It's got a very strong rule of law that we can count on there. That's important. It's had I would say, a quite consistent fiscal regime for a long period of time. So we feel that we can count on not having a lot of changes to the government fiscal rules around the assets. So we like the overall jurisdiction in kind of legal and economic terms. The second thing is we like it technically. These are, again, they're conventional fields, but they're big ones typically. Rotliegend sandstone is by far the main producer. We've worked on the Rotliegend throughout Europe, in the team's history from Poland all the way to UK. It's sort of been the mainstay of the European industry, I would say. There's obviously a lot of production in Norway as well. But for this kind of non-Norwegian part of the industry, it's been really, this reservoir has been the mainstay of development. We understand it. We think we are capable of identifying the projects that will work well in it. Because it's conventional production, it does lend itself to workovers on existing wells, and it does lend itself to development and extensional drilling. And we think with the seismic data set that exists basically over the entire acreage base that we acquire offshore, we think we can identify some good exploration targets as well. Raw exploration, frontier exploration is not the mainstay of our company, but if we have some closer in opportunities to drill exploratory wells or some large exploratory targets in producing zones like the Rotliegend, even if they're a little bit away from existing platforms, but still close to, say, pipeline infrastructure, we will consider those. And I think one day we'll have investments in those. We're hoping at pretty good rates of return. So when you have a set of producing fields in a zone like the Rotliegend, you get this whole range of reinvestment opportunities from workovers to development drilling to exploration. And you have a highly predictable, we think, base level of production as well. So it's got a lot of technical advantages that we understand. We're very much bullish on the Netherlands industry. We know that the government there has a renewed desire to have offshore development occur to augment domestic gas supply. And I'd say, thirdly, we like the standards that exist in the industry in Netherlands. They're the highest standards of HSE. That's the kind of environment that we would thrive in. And over the longer term, there's a commitment on part of Netherlands as well to have CCS projects, other things that improve the carbon neutrality of the industry, and eventually development of a hydrogen industry offshore. And we may have a role in that as well through some of our midstream and other investments in the Netherlands, the new assets and in the existing ones that we had before this deal.
Well, let's double click and zoom in a bit on the recent NAM deal that you did, because it was the way you structured it that I found particularly fascinating. It changes the face of the company. You're adding a significant amount of production, and you're doing it without issuing equity, which is a shareholder dream. Could you walk us through how you structured this and how the actual deal is going to play out, like what the terms will be?
Yeah, I mean, the consideration that we have in this transaction, there's actually in the end 4 forms. There's a firm base consideration, and then there's 3 forms of contingencies. And I'll briefly, I think I'll run through each of those. And of course, as you pointed out in your question, our objective would be, where possible, to make transactions to increase the size of the company, to grow without having to pump out a bunch of additional shares, because we are here to work for the existing shareholders in the company. Since a recap, in fact, we've retired 7% of the shares through a buyback program. And obviously, that's an example of our desire to avoid dilution, kind of a negative dilution. And if we can do that as we add assets to the company, it's our preferred way of going about it. We have a base consideration here that I think is a fair level, 165 million euros at an effective date of Jan 1, 24. So, I mean, we're already up to August 24, and it will take most of a year probably from here to close the transaction. There's various steps that have to occur in making the switch over from NAM to Tenaz. And during that whole period up to closing, remember, effective date Jan 1/24, closing date not absolutely determined, but estimated to be middle of next year. That's an 18-month period. The assets are producing cash flow that entire time. And a fair amount of that cash flow is protected by hedging at attractive prices for the first 3 quarters, fixed prices on something around half the production, and a collar at reasonable levels in Q4 of 24. Then we have additional hedges placed more recently in the market for 25 that would be affecting this interim period cash flow up to the middle of the year. Then they extend on another year and a half after that, second half of 25 and 26 as well. And so with that set of pricing on a portion of the production locked in, roughly half of it, there's not as much risk to the interim period cash flows. All told, the interim period cash flows will be deducted from that $165 million at close. This would be the interim period free cash flow. There's not a very large capex stream at all planned for the assets for this year and the first half of next year up to closing. So almost all the cash flow is free cash. It comes off the purchase price. We have already placed a deposit, which we placed out of existing liquidity that we had in the company without bringing in new equity financing. So that deposit comes off. It's complicated formula in terms of the actual closing amount because it depends on the cash flows. Of course, the deposit is already fixed, and then it depends on these working capital adjustments that may occur in the balance sheet at close. But currently, we've estimated something in the range of 30 million euros at close. So to make sure that 30 million is completely financed, we entered into a new banking arrangement, a new credit arrangement with National Bank of Canada. Been a supporter of the company a long time, all the way back to the recap. They were our advisor and a kind of underwriter on the recap. And that provides in total about 110 million Canadian of financing. It should be way in excess of anything that we might need to close. And that's how, in this case, we're able to do it really without equity financing to make the close. I should mention the three contingencies. One is a sharing of the 3-year free cash flow from the assets. This would be cash flow minus the capital that we would reinvest, including after we become the operator. So it's half of it for 25, half of it for 26, a quarter of it for 27. There's no minimum, calling this the earnout or the contingent earnout portion of the consideration. There's no minimum level required, and it's capped out at 120 million euros. And if it falls short of 120 million euros, there's no requirement for us to make any of that up. That's one contingency. The second contingency is a exploration contingency. There's a lot of exploration licenses and good prospects that come with this acquisition. If we make quite a large new discovery on these existing NOBV licenses, and it reaches a pretty big production level, about a half a BCM, we would begin paying a royalty to NAM, and if it gets up to a BCM out of a single discovery, we pay a little bit more royalty. So if we make a discovery at that level, I quoted those in billions of cubic meters, it would be 17.5 to 35 billion cubic feet, or BCF, the terms we typically talk in North America. Those would be big discoveries that I think we would have done really well with before we ever have to pay any kind of royalty. That's exploration contingency. And then from 2028 to 2031, there's a price contingency that lets NAM step into a minority of the A tax increment associated with gas pricing after you move up 50% roughly above current levels. There's an initial level and then a little bit higher sharing if we go up to as high as 60 euros per megawatt hour. Currently, the price is about 40 for the prompt, and these are quite high prices compared to North America. If you convert that, it would be something on the order of even the 40 the euros per megawatt hour. The current price would be something on the order of 16 Canadian per MMBTU, something like that, just roughly. So you get to 50% above those levels, where you get the maximum potential sharing for that period of time. You'd be at very, very high pricing, and I think presumably very high cash flow levels coming out of the property. So these contingencies are structured such that if we pay them, we would have been, I think, doing quite well with the properties. Particularly, I would say that applies to the volume and price contingencies. And then the free cash contingent earnout, we still keep the half for the first 2 years and 3/4 for the third year of the project. So I think it's good structuring. It provides upside to the seller and lowers that initial consideration for us and really lowers the risk, because when we pay more, we will have been doing better with the assets that we acquired.
Wow. I'm going to be massively oversimplifying this, but bear with me. Am I correct in saying Exxon and Shell, they say, we've got this asset and it's a future liability. It's basically the production is peanuts for us compared to the whole operation, and we don't really plan on reinvesting in it. So we just want to find a good home with a different buyer. You guys come to the table, and in addition to the other points of consideration, they say, hey, for the period while we're closing this, take all the free cash flow from the business and use that towards paying for the deal. Is that a wildly simplified and correct, or?
I think it's a very intelligent way to simplify it. I don't want to speak for the sellers, in their overall decision making and strategies, business plans that they have for their enterprises. But I think it's generally accurate to say it's in their scale, in their scheme of things, it's not a very significant asset. And what you say, I think, is basically true. Way to simplify the transaction.
It's just incredible. You just don't see deals structured like that often, and it's sometimes at first glance kind of almost looks too good to be true. And then I just try to understand the motivation, and it's very impressive how you structure it.
I think it's a reasonable transaction for both parties. And again, if these exploration contingencies were to come through, if the pricing contingency were to lead to a payout on that, both parties will have done extraordinarily well. So that's a way to contingently, I think, for those sellers, capture some value, and it helps us get the deal done. I think it truly is a good transaction for both the parties, and I think it works in our business model. We're looking forward to having that staff because we know that they can generate a lot of inexpensive, high rate of return, probably quite low risk projects, even out of the existing well stock, lead to some higher investments over time when we would ultimately drill and extend the life of these fields, more revenue over time for the Dutch government, more employment. Really, it's kind of a win-win-win-win, I think, buyer, seller, workforce, Dutch nation.
No, very interesting. I was curious, you mentioned earlier just discussing your existing assets. So perhaps you could dive into your Leduc Woodbend project and how that is going, and as well as the idea behind the actual acquisition as well.
Okay. I'm happy to talk about Leduc Woodbend too. This is the asset that the company that we recapitalized, Altura, had in its portfolio. It was really basically a new discovery by Altura, even though it's pretty shallow, 1,300 meters deep, in an area where there has been much drilling to deeper depths than that. So it had been drilled through many, many times, tested, produced just a tiny bit in the history. But the team at Altura and the gentleman who was the CEO of Altura, David Burkhardt, is still a part of our team. We had worked with him previously at our predecessor company. So we knew him well. That was one reason probably we were able to get the deal done. But they had found quite a nice field at Leduc Woodbend, drilling horizontal wells in a sandstone and using some of the newer completion techniques to produce this, really conventional but low perm, but conventional reservoir. This is not an ultra tight. It's not a shale. It's nothing like that, like you hear about, for example, in the Permian Basin. It's just not the same kind of rock, nor it is the same, nor is it the kind of scale of completions. Semi-conventional is the way we refer to it. It would be a lower perm, but not ultra tight reservoir being drilled with horizontals. Big pool that they discovered. They began drilling horizontals. Performance of the wells has gotten better and better as we moved up the learning curve about how to optimize longer wells, more completion stages in the wells have led to better performance. It's an oil project that does produce a little bit of solution gas that we sell as well in the AECO market. But the main reason for AECO's pretty low price product, and the main reason for doing it is to get the oil. We've been able, and we're going to continue, I think, to increase production rates out of the field. It's got quite good infrastructure. We recently bought a plant and a little bit more leasehold in the area that gives us, I think, better control and even better longer-term growth prospects in the area. So it's not a big project. It's not as big as NOBV, but it's going to grow, I think, probably pretty ratably as it's done for the last few years since we've had it. And, it's a meaningful element of value for the company and an example of what we do to try to improve performance when we operate to drive up production. And, I think it should be a good source of free cash flow in the future, too. Got multiple zones present. We've really only focused on one of them to date, the so-called Rex Formation as part of the Manville Group. There's a number of other Manville sands that are somewhat similar that we think we can develop. And so it's just a good project that represented at the time we did the recap of Altura, very good value in itself. So it's an example of what we attempt to do when we acquire. We wanted Altura because we wanted the public vehicle, but we wanted to do that particular recap because we felt that the asset had a lot more value than was represented in that time for Altura in the capital markets. And that's why we focused on that one. And I think Altura's management board did a great thing by moving to the new strategy and our new company, Tenaz. We kept John Chambers. We're fortunate to keep John Chambers on the board. He'd been on Altura's and now he's on Tenaz's board. And we brought in a new set of board members led by Marty Proctor, our chair, who is a great oil and gas professional for a long time in the Canadian and international industry. He ran 7 gens very successfully, and I'd worked with him previously at Baytex. So we're able to put together a board led by Marty that I think provides great guidance to the company and really covers all this quite broad range of expertise that is required today in the capital markets, especially if you're running an international model, as is Tenaz.
Just a quick aside, where did the name Tenaz come from? I'm curious.
It's a Spanish word. It means tenacity. We look for names that weren't really taken, that we thought had a nice ring and also captured the philosophy of the company. In this acquisition business, you look at many, many, many assets. You look at many, many enterprises, and most of them aren't going to represent good value. In that set that does, only on a small percentage of those are you actually potentially able to make deals. So it requires a great deal of perseverance, and that word tenacity kind of captured the way that we would go about it in the M&A or A&D business, because the key thing there is discipline, consistency, accurate technical evaluation, again, well by well, project by project. It's a lot of work. It's a lot of technical work. It's interesting work, but nonetheless, only a very, very small number of projects, a super low percentage of projects, very low single digits, will ever make it to fruition. So it kind of requires tenacity to make it work in that kind of business model.
Cool explanation. Well, it seems to be working for you. And I wanted to talk about the financials you just posted recently. You swung to net profit, which is excellent. Do you want to run us through a few highlights for the quarter? What stands out to you?
The funny thing about Q2 is it was pretty much just as expected for us. Production was down a little bit as the Leduc Woodbend wells declined a little bit after we had drilled them in the second half of last year. We'll resume drilling here in Q3, to resume growth in Leduc Woodbend. And Netherlands asset produced as expected. There was maintenance, as usually occurs in kind of the springtime of year, leading to a drop in rate there. So the production was as we expected. Cash flow was pretty much as expected. Minor swing from loss to positive net income. Kind of for us, a quarter that unfolded as we would have thought. With the assets that are owned today, Leduc Woodbend and the non-operated set in Netherlands, will continue with the same activities we had previously, drilling in Canada, production, by our operators that we're a non-op with in Netherlands. And NOBV will not be counted until closing in the rates or cash flow. Everything that occurs in monetarily until then is, as we talked about earlier, a reduction in purchase price. So for us, it's just going to be the continuation of the development of the existing assets. There's going to be a lot of work on this closing and transition of NOBV. There is going to be uninterrupted work on what we call our transaction pipeline for M&A. We try to maintain a number of projects in there, somewhat diversified by product and geography. Again, only a very, very small number will get all the way to announcement like we just had with NOBV. But we're hopeful. We don't offer any guarantees about the certainty or about the timing of further deals, but that for a number of people in our company, that is going to be the other main focus, just continuing to advance acquisitions and hopefully get them to the point of signing definitive agreements, making the announcement, and then proceeding to closing. So it'll be continued operation of the base assets, continued administration of the non-ops in Netherlands, the transition and closing of NOBV, and advancing the acquisition pipeline.
Well, one thing that stood out to me about the business itself is just the high level of insider ownership in the company. And so I was kind of curious if you could just speak to perhaps why that is important from the insiders within the business and why you have taken that approach in ownership.
Yeah, I think it's just the right thing to do. As an investor, I would always be looking at that director and officer employee ownership of the company. I think we can all see that it's important that the managers in the company are in the same boat really as the rest of the shareholders who are taking risk with their capital. You do want your employees and your management to be kind of hot under the collar if the company doesn't perform well. You want them to be building value for the long term, trying to make all the right NAV decisions over time. You want them to be judicious with the use of company shares. We've been fortunate to date. We haven't had to issues since we made the original recap investment that all of the officers and directors at the time invested in. That is really, I think, fundamental, that you want the employees in the company to have skin in the game. You want them to be incentivized to produce for the shareholders to the greatest extent possible. You want them in the same boat as the rest of the shareholders. I probably didn't do a very good job of explaining why, but to me, it's just fundamental, and it's just critical, really, that you have manager owners, employee owners of the company, and that is what we do have. A lot of it, of course, came in through the original recap investment, and a number of people that have joined the company have been investors, officers, and others, and directors, even after the recap.
We love to see it, and we know that the importance of it, you say hot under the collar, what an excellent way to put it. You want to see a little bit of the pressure on the team to make sure everyone's performing and all rowing in the same boat. But then we also love seeing the normal course issuer bid. You're buying stocks, retiring them from the market. And clearly by being owners, focusing on that share count, it's so valuable and so important to you for your own compensation that, you're looking at new deal structures and, preserving that equity. I think it all kind of, it's all related. So we get why. And I just wanted to kind of zoom out a little bit because the macro environment everywhere is I guess uncertain is the way I'll say, whether it's US, Canada, international, there's a lot of question marks out there. If we're talking about, oil and gas specifically, I'd love to just get a little bit of thought leadership from you. Like, how do you feel about the overall market and what's going on? I don't mean overall stock market, specifically like oil and gas, but what's your take on the current status of the world and how things are looking for you? That's a pretty big question.
The status of the world is a big one. Of course, it's all in our our minds. To start with oil and gas, I guess a critical thing there is always the product price, the commodity price. It's volatile. It can be controlled to some degree. We try to do that through hedging. We recently placed a few more hedges on our existing production. We have the pretty healthy, quite healthy hedge profile in place for NOBV already, about 46%, I think it is, for the 3 years compared to the current production curve. So that is one way you can control it. We like to try to do that when we think that prices are up. They're not always going to be up. They're going to go up. They're going to go down. The products that we're in WCS. Luke Woodbend Oil sells as WCS. It doesn't require any diluent, so that's definitely a cost or a realized price advantage, but we can just sell the crude directly as CS. And it's been, I think, a pretty good product. Diffs have narrowed. The WTI that the WCS differentials are deducted from is a relatively a strong product. And I think to maintain oil production, actually increase it to match the still decent demand growth that occurs for oil, probably is going to call for at least a maintenance, I would say, of oil's purchasing power. Maybe it'll go up in real terms. The economy has been able to live with higher prices previously. In case a higher oil price is required to match that increase in demand. So reasonably constructive on oil, I would say. On natural gas, we produce a little bit in North America at an AECO price, and it's not a very strong price. We just recently hedged some at about 220 Canadian per MMBTU for, I think, for next summer. So it gives you some idea that this isn't a super strong product. And this is why we prefer to produce our natural gas outside of North America into these international markets that really rely for supply on at the margin, probably on LNG. In TTF, again, we have quite strong prices right now. It's around at a prompt price. I mean, hey, this is September pricing, a shoulder month where there typically isn't tremendous demand. It's still 40 euros per megawatt hour. And just converting that in my head, I think that will be around 16 Canadian per MMBTU. I might be a little bit off on that. Suffice to say, it's quite a strong product compared to the prices that we have in North America. So for us, the products that we would emphasize would be TTF gas. That's what we would like to add over time. There might be some other markets in the world, gas markets in the world that would be acceptable as well. And oil is certainly an acceptable product for us. Not so much probably emphasizing North American oil, more going back to the M&A model we talked about earlier, but maybe Brent oil that can be added to the portfolio over time. So we will strive for a pretty balanced product mix over time. No guarantee again on what deals might occur, but a lot of the things that we would pursue think are going to be Brent oil on top of this TTF gas. So that's kind of the macro view, the preference for overseas gas, thinking that, oil internationally can probably at least maintain its purchasing power. The overall situation in the markets is beyond really my capability to predict. You don't see these energy issues trading at particularly high multiples, it seems to me. I'm not saying there's going to be a multiple expansion, but I wouldn't bet on a multiple contraction for the sector. Some of these other sectors are generating super high multiples in comparison to energy or basic materials, I would say in a lot of cases. So I'm not saying that the other multiples, tech and others, can't even go up from here. I don't know, but I know that we start at a much lower level, and that might be one reason to potentially favor our industry. The world economy, I think it continues to grow. I think energy demand continues to grow. For sure, we want the renewable contributions to the energy mix, but at the same time, I think you're going to need more oil, has been demonstrated in the demand increases, and probably a fair amount more gas. Of course, it's better as a carbon product than the oil is. Carbon intensity is better for the gas. So I think our industry can continue to go up, and our goal is going to be to try to produce value out of the transactions and subsequent operating that we can do. And I don't have any idea really what kind of market multiple will be accorded that. But, we certainly don't start out at the high levels of the sectors that are really have led these stock markets higher. So that would be my comment if I just restrict it to kind of market and macroeconomic conditions.
Excellent. Well, I would say for somebody looking at this story, perhaps they've read our article, whatever it was. I think the first one was 2 years ago, almost, maybe a little bit less than that. They would have seen, it's over the last year, the stock's up over 100%. Since we've written our article, it's up over 300%. For somebody looking at this saying, damn, I missed the boat. I should have invested. I didn't. It's too late now. What would you say to an investor with that point of view?
I mean, well, we in the company own the shares, right? We've been sticking with it for sure. That shouldn't be your only indicator. You want to absolutely want to make your own assessment. I mean, the stock's gone up, but the company has grown quite a bit in that time. And then secondly, we have announced this definitive agreement to acquire NOBV. And on a pro forma basis, of course, we'd be a much, much larger company with more widgets of gas and oil that we will be producing. There's a lot more cash flow. There's a lot more free cash flow. So, I think that it would be appropriate for investors to consider that as well, and maybe make some of these comparisons of Tenaz to the overall sector, and perhaps at the same time you want to make your comparisons of the sector to the overall market when considering, does it still represent value? We never want to make any kind of prediction about the stock price. We're not going to do that. What we're going to try to do actually inside the company is try to create the real value, the real stream of product, the widgets, the cash flow, the free cash flow that goes with it. It's going to be up to the market to value that. I don't think we're a very promotional company. I think our philosophy is we'll try to put out the basic information. We would talk to any investors who were interested in talking about Tenaz, and we kind of let them make their own decisions. Our goal is to try to, if we can, put more of every one of these desirable streams, like production, like reserves, like cash flow and free cash flow, behind every share. And if we'll strive to do that, again, don't guarantee that, but we will strive to do it. It's been the record, I think, to date. And if we continue that, the market's pretty efficient over time. Presumably, it will recognize that correct value.
Fair answer. There's a few things, pieces of math in my head, seeing when I was in the institutional business, I know there's a certain threshold for our mandates to even consider a small company, and it's usually 300 million roughly. So you're kind of right on this edge where I could see this transition from being a retail story to more of an institutional story. And there's that kind of awkward in-between phase while retail scratching their heads, trying to understand the numbers and why is it at such good value. And then institutions are kind of just there watching and waiting until they're allowed to buy, in many cases, in their mandate. So we love this awkward middle ground because it gives us a chance when markets aren't inefficient in the short run. And I agree with you, in the long run, they should be. But, you see something like this, and this is exactly why we get excited about this area of the market, finding those, hidden gems, if you will.
That's a super interesting point that you make, because we certainly have been down, well, probably at the time of the recap, I don't know what you would call it, nano cap territory. We're not a mid cap today by any means, so I guess we're still micro cap. But fortunately, I think moving up in that market cap, a portion of that is represented by net working capital, of course, in the market cap. Before you get to EV, it is good, I think, to move up. Nothing wrong with retail investors. We've got a number of them. A lot of them have been quite loyal to us. When you're down in what I call this nano cap or micro cap today status, it's sort of a different investor relations than you would have in the mid cap or bigger sector. We do have some institutions that own the stock. We do talk to institutions on a regular basis to attempt to get them interested. It is good, I think, to move up in market cap and in liquidity, which we have moved up substantially, kind of in a series of steps since the recap. And when we get that little bit bigger market cap, and maybe equally important, this higher liquidity like we have seen grow for the last, almost the last 3 years since the recap was traded. I think that's what's very, very important. And then we can appeal, hope, to a larger number of investors. And then we shift a little bit more probably into a IR strategy closer to what we would have had at the recap, which is a real combination of retail and institutional IR.
Well, that's, that concludes it for my question. Tony, thank you so much for spending this time with us. I know how busy you are. You probably got deals to go structure, so we won't slow you down. But hey, we speak directly to a retail audience. So for all these people following us and been curious about your story, because we've been talking about you a whole lot, I think it's great to see the CEO, and we appreciate what you're doing for us, what you're doing for the company, doing for shareholders. And, we enjoyed this. We'd love to have you back. And I just want to say thank you again, because we really do appreciate it.
Gentlemen, it was my pleasure. Thank you so much.
Excellent.
Okay.
Well, you take care, shareholders. If you're watching this, this is Tenaz Energy CEO Anthony Marino. Stock trades on the Toronto Stock Exchange, tnz.to. And if you've got questions, you know where to find us. So thanks, guys, and tune in again next time.